We are talking interest rates this morning, but today it's not the US that's in focus, it is the UK. The Bank of England has raised interest rates to 1%, a 13-year high. What does that mean for UAE interest in the UK property market? Very pleased to be joined now by Henry Faun, head of the private office for Knight Frank Middle East. Henry, it's lovely to see you in the studio.
Brandy, Richard, it is a pleasure to see you in person too.
So this rate hike, this rate rise is not a surprise, but it is, you could say, unwelcome in some sectors. Will it have any effect on interest in the UK property market?
Great question there. As you mentioned, it is not a surprise for anyone looking at the UK property market or those holding real estate already in the UK. Now, in reality, what does it mean for those of us that perhaps have a mortgage in the UK or are looking at one? If we took an example of a £200,000 mortgage loan over a 25-year term, at the moment, on a variable rate, this current increase would mean about £25 per month more coming out of your pocket. Now, in reality, will that affect house prices in the UK or our interest here from the Middle East, perhaps the UK? Potentially not, but it is certainly something to consider in the UK as a wider cost of living.
And it's also seen, I think, as being the thin edge of the wedge. I mean, if we take away the numbers and just look at the rhetoric coming out from the Bank of England yesterday, they were talking about potential 10% inflation. They were talking about a potential recession. They were talking about the high cost of everything, but particularly energy, which would signal that more rate rises are to come.
Correct, both in the UK, perhaps in the US as well, and therefore locally here.
How high would interest rates have to get before they really started putting off buyers?
Good question, Brandy. The reality is that most of our buyers these days aren't necessarily taking the variable rate loans. Most of our buyers tend to take a 5 or 10-year fixed term, and perhaps they can then roll over a new fixed term after that. And therefore, the shocks in terms of increasing rates on a monthly or quarterly basis affect them a little less.
Rich and I had lunch yesterday in your neighbourhood, which also happens to be my neighbourhood, and we discussed the weighing up that a lot of expats do. Do you buy at home? Do you buy in your adopted home? Do you buy where you think you might end up? Do interest rate rises in any countries actually affect that decision?
They certainly would do. The reality is if we were weighing up the options of buying here locally in Dubai versus perhaps renting for that foreseeable future, it will be a good calculation to calculate your forecast payments in terms of your rent versus those mortgage payments as well. And we could do the same calculation for the UK for an investment.
Talk to me about what's actually happening in the UK property market at the moment. We saw a bit of a hollowing out in cities around the world, and London no exception, in terms of where people wanted to live amid lockdowns. Where are we with that?
In the past 18 months, we've seen a race to greener areas. And by that, I mean from the central cities, London, for example, people have raced to the outer areas where they can perhaps afford for the same money a house with a garden and perhaps another home office there as well. What we're now seeing in the past few months is a more recent trend. We're calling that boomerang effect, where those buyers and perhaps renters have gone out to the home counties and are now coming back into central London as the lockdown measures have been.
What does that mean for prices?
Rents have actually trickled up a little bit first, and we're forecasting prime central London prices to continue as well. The prices in London have actually increased to May this year 2% or so, and we're forecasting 3.5% total for 2022.
And what does that mean for the attractiveness for people from here? Prices going up, but also potentially maybe your yields if you're a landlord.
Correct. Over the coming 5 years is probably a good window to start with. I would suggest that most buy-to-let investors looking at London, for example, take a 10 or 12 plus year window on those properties. The reality is that if we can get a growth of around 22%, which we forecast in central London over the coming 5 years, and rents potentially to increase by 17% on their current rate, then actually capital growth and yield is looking quite positive for now.
That's a hefty increase, 17%, given the cost of living crisis that the Bank of England was talking about yesterday. Is that sustainable?
It's actually due to a lack of supply, Brandy. There's a few things that are contributing to all of this. So we've got the lack of supply. So both people are not putting their houses on the market to sell or rent, and house builders are not necessarily handing over the same volumes. We've got lower cost of borrowing, which has been at record low levels for a number of years. We've actually got that flight to green space. And also we've got the accumulated wealth. So many have actually been at home in the past couple of years, not travelling, not buying items or spending it on holidays. And that has actually also affected the new purchases and renting.
Are we not potentially moving into a situation, though, where a lot of people can't we were already talking about, a generation of people, of millennials who might never own a home. But if we see that cost of living increase, if we see inflation increase, is it going to price more people out of the market?
I would suggest in some areas, for example, if we took the most central areas in the middle of London, many of us cannot afford to live there anyway. And if things do change by, £25 per month on our mortgage, we still will not be able to afford to live there. Where most do tend to live is on the outer areas of London, which can be a bit more affordable, or we can move to other areas as well, which are still commutable to your work.
Okay, so you're British. It's your home market. How attractive is it remaining for those for whom it's not? Because we're not being British-centric here on the Business Breakfast. London, the UK in general, has always been a big draw for money from this region, regardless of passport.
Correct. The ease of travel, language, education, and lifestyle factors in the UK are all the full package that it offers in terms of owning a property there. There are other cities as well that certainly those from the region here, I wouldn't just necessarily pick the UAE, but wider region tend to look at as well as a second home, perhaps France or Spain, or even over towards the US.
So before we let you go, Henry, how high do you expect interest rates in the UK to go? What's your outlook? I
couldn't possibly say for now, but we'll see how inflation goes. The forecast for the end of this year for inflation is around about 7%. So if that comes down a little bit to the bank's target 2.0, we'll see how interest rates track that.
Well, the official language coming out of the UK is that some degree of further tightening in monetary policy might still be appropriate in the coming months. So watch this space. Henry Faun, head of the private office for Knight Frank Middle East, thank you very much for joining us on the Business Breakfast this morning.
Thank you very much, Brandy.
Rich, you're about to hop on a plane to go to the UK.